Okay, so we'll start with FMP 4, week 7, according to the live class schedule this time. Okay, so now this is a shift from quants to the FMP portion, which many of you probably will find a little more settling, a little more, you can say, easy as compared to quants. Okay, so, and of course, interesting as well. So let's start, and we need to understand that this is a chapter. I mean, the name itself is very clear on the fact that this is just an introduction to derivatives, which means that many of the concepts which will be introduced in in this chapter will be discussed in detail in later chapters or later sections. Okay, so we'll be just introducing the gist of some of the important instruments. Okay, and then in later chapters we'll see more details. So we can start now. So what are the learning objectives? We learn about the markets, exchange traded markets, over the counter markets, market size. We'll see forward contracts, futures contracts, and we'll see options. We have a separate chapter on futures contracts today. Okay. Options, we have separate chapters later on after one or two classes. And then we'll see market participants. Okay. We'll see hedgers, speculators, arbitrageurs with some examples, and what are the risks of dealing with derivatives. So some of these, as some of the ideas will be theoretical, which you can go through the directly the PDF, but most of the ideas are conceptual, which we'll study in the class itself. Okay, so let's start by introducing what are derivatives. So derivatives are contracts whose values depend on or derived from the values of one or more financial variables. Okay, so what are the examples of these variables? You can have equity prices as variables, exchange rates as variables, interest rates can be variables. Okay, so each of these variables will be referred to as the underlying asset. Now, derivatives can be categorized into two types. You can have linear products and you can have non-linear products. And they can be traded on two types of platforms. They can be traded on exchanges and they can be traded on over-the-counter markets. Now, exchanges are basically organized markets, and over-the-counter markets are markets where trades occur directly between the parties. Okay, so an exchange, you have standardized contracts which are being traded. Okay, these standardized contracts, all the terms and conditions of these contracts are defined by the exchange itself. Meanwhile, in over the counter markets, participants directly trade with one another, okay, often with the help of brokers who act as intermediaries. So this uses of derivatives you can directly cover from the PDF. Now let's explore the market size of derivatives. So this table, it gives you an illustration, okay, of the underlying assets in derivatives markets at 2 points in time. One, you have June 1998, and then you have June 2019. So you can see that in exchange traded markets, the value has increased significantly. It has increased from 13.3 trillion USDs, and these are in trillions of USDs. So 13.3 trillion USDs in 1998 to 120.3 trillion USDs in 2019. Okay, now this indicates the growing popularity and use of standardized contracts on exchanges. Similarly, in over-the-counter markets as well, the growth is remarkable. If you see, I mean, from 72.1 trillion dollars in 1998 to, you can say, this staggering figure of 640.4 trillion dollars in 2019. Okay, so you can say that OTC markets, they actually play a very dominant role in this derivatives landscape. Okay, and of course, if you see together both these markets, these numbers across different markets, they actually emphasize the massive expansion of derivatives markets over the 2 decades between 1998 and 2019. Okay, so they are very critical in global financial systems, which is clearly evident in the numbers. So you can see you have the changes in the market size of derivatives over time. Now, if you want to analyze this part carefully, you can see there is a very, very massive growth in OTC. In fact, as compared to exchange traded, the figures actually that we saw between 2000, between 1998 and 2019. I mean, if you just compare them with the figures between only 1998 to say somewhere around 2008, just before the financial crisis, okay, you'll see that the expansion in OTC was even more as compared to exchange rate between this time, because after that there has been a kind of a roller coaster for OTC. But yeah, exchange traded has also, it also decreased around this point, but yeah, overall it has increased. So to understand the ideas, to understand the evolution of the size, we can just do one thing. We can just break this into a few manageable segments. Is there any doubt which has been asked? Uh, yeah, Nitin has asked, what is it in 2025? I think we can just check. You can just check search. I think it'll be a little higher, not too high, a little higher, of course, as compared to 2019. Okay, maybe in 700 trillions, 700s trillions of dollars for OTC. And for exchange, I think it can be, if suppose in 2019 June it was 120, probably around 130, 140, something like that. You can check, or maybe even more. Okay, we'll have to check. I don't know the exact figures as of now. So Vedant is asking, any real world examples of exchanges and OTC markets, some not close to the, sorry, not close to the international markets aspect. Yeah, absolutely. See, in India we have the Multi Commodity Exchange of India, the MCX, which is um, one of the biggest commodity exchanges of the world. So it trades a lot in futures contracts. Okay, so we have that example. And OTC, basically, see, OTC, you don't need any example. OTC is all about direct participation between any two institutions. Okay, mainly uh, big uh, wholesale institutions, they deal in OTC markets generally, of course, but it can be between, even between small parties as well, smaller parties as well. So any broker in between, any intermediary in between, any investment bank in between, you can have, and then you can have two parties taking positions with each other. Okay, Vedant. Okay, Lucky, you've also raised your hand. You want to say something? Lucky. Okay. Okay, Lucky is asking, so can we say irregulated markets is bigger? Absolutely, yes. Unregulated markets is bigger than regulated, but when we go to the later sections, we'll find that after 2007, actually, even the OTC markets, which were largely unregulated in many aspects, not in all aspects, they were largely regulated in many aspects before 2007. But after 2007 to 2008, after the financial crisis, there have been acts and regulations which have been passed, and even OTC markets are being regulated to a much higher extent as compared to what they were during the or before the 2007-8 financial crisis. Okay, so Lucky asks, what about crypto derivatives? Again, I mean, largely unregulated. Okay, not I'm saying not completely unregulated. Okay, but largely there are many aspects. So we as FRM candidates, how do we deal with unregulated? See, uh, as far as interaction is concerned, I mean, let's say you are, because the interaction with these segments, you will be having only in your job roles, because in the FRM curriculum, it will be basically in the form of question and answers. That is the interaction that you can have. So you will be very clear by just going through the curriculum how to deal with these in terms of questions, of course. But yeah, in terms of real world interaction in your jobs, it is possible some of you might be even dealing with derivatives now. So of course, depending upon what kind of norms, what kind of regulations are being set by your employer as well as your institution as well as the regulator, because it's not only about the employer regulations or the, say, country regulations only. You have to manage. In fact, the financial institutions, they manage, they actually try to balance the regulations which are present in the country and which are present in the uh, or which are given by the regulator directly. And in fact, the norm in the industry, generally, I'm telling you, may not always be the case, but the norm lucky in the industry is that if suppose you have two different sets of regulations, let's say you have country based regulations based on your country, and you have, say, regulator based regulations, say Basel is a regulator, and mm, Basel actually not a regulator. If you see, Basel is a body which creates standards to which regulators try to adhere as much as possible. But if there are some international regulations, okay, so generally the standards, the norm is that the financial institutions they generally try to go with the stricter set of regulations, even though more capital will be tied up in that case. And we'll see some instances also, particularly in FRM part 2 when we talk about regulations. So there are a lot of discussions going on with respect to this part in FRM part 2. Okay, so generally stricter regulations. As FRM candidates, you should always try to adhere to the stricter part. Okay. Okay, Vedant is asking in if OTC markets don't exist as specific platforms, how do we gauge the size of the OTC market? See, even though they might not exist as specific platforms. In fact, nowadays electronic trading, most of the trading is done electronically, even in OTC markets. But see, the recordings, I mean, the underlying assets, if suppose two parties are dealing with derivatives contracts, let's say worth of $500 million, for example, the size of the underlying asset, okay, it has to be reported at least. I mean, it will be there, right? It will be there not only on their balance sheets, but also if suppose that segment of OTC market is actually asking you for more, you can say, detailed records on the company's, say, websites or on the company's statements, and also to some other governing body, then of course the records are always there, even if they are not existing as specific platforms. The records are always there, Vedant, right? So based on all the records, of course, you can gauge the size of the OTC market. I mean, earlier at least, if suppose electronic trading was not existent before, say, 1990 or 1985, then of course the best way to deal with or to find out the size was to go through all the records which are completely in open. But nowadays it's not very difficult because since all the trades are taking place electronically, so even though you don't have specific platforms, okay, but there are gateways, right, through which the trading is taking place, the interactions are happening. So nowadays it's actually even easier. Okay, so if you want to understand the evolution, especially after 2007, we can try and break this into some manageable segments. As I said, we can just do one thing. I mean, I'll replicate this graph. I've just squished, or you can say squeeze the graph vertically, so that's why it looks a bit elongated. So let's just look at different segments. Let's start with OTC. Okay. Now this OTC market, as you can see, it exhibits rapid growth until 2007. Okay, followed by a lot of fluctuations. Now the first thing, of course, there are fluctuations, as I said, a lot of fluctuations. The first thing, of course, that the first part of the fluctuation that you see is over here, this part. Of course, this part can be attributed to the global financial crisis, which we'll study later in Foundations of Risk Management chapters. Okay. Then after the crisis, steadily after the new acts and everything, they start to come up. They again start to increase. Okay. But then there are again some major periods of ups and downs, mostly this part. Okay, this one, this purple part, which we have highlighted over here. So one more overall period of decline, because again, there's a decline, then again up, then decline. So overall, there's a decline. If you look from this point to this point, overall, there's a decline. So one more overall period of decline, June 2013 to June 2015. Now, this can be attributed to a technique which is called as compression. Again, this we'll study later on. This is a theoretical idea. You can go through it in FMP 6. It's actually explained in more detail, FMP 5 and 6, and not actually in detail. I'll say it's still introduced, but because compression is discussed and the dynamics of compression are also discussed in detail in FRM part 2, the credit risk module. Okay. So this is actually, I'll just give you a brief. This is a procedure to restructure the transactions so that underlying principal can be reduced. Okay. Then, in spite of these changes, the market has actually stabilized to some high levels by 2019. You can see that. Now let's come to the exchange traded segment. Now even exchange traded, you can see that mostly it is increasing except for this part, which is except for the global financial crisis. Okay, so steady and consistent growth in exchange traded markets. And after 2008, there were regulatory changes which promoted exchange traded derivatives more due to transparency and standardization. But still, you see, OTC has still grown a lot. Okay. Okay, now let's discuss forward contract. So a forward contract is a type of over-the-counter agreement between two parties. So in this agreement, one of the parties is agreeing to buy an asset and the other party is agreeing to sell the asset. Both of them, of course, they are doing it at a predetermined price, the same predetermined price at a future date, future time. Okay. Now this predetermined price is often known as the exercise price, or you can say strike price or delivery price. Okay, Raj Lakshmi is asking, are all the forwards over the counter? Yes, forwards are all over the counter contracts. So this future date, which we are talking about, is known as the expiration date, okay, of the contract. So we can just take an illustration. Suppose you have this underlying asset. Okay, there are two parties, party A and party B. So party A agrees to buy this underlying asset from party B. Okay, while party B agrees to sell this underlying asset to party A. Okay, all based on the terms and conditions of the forward contract. Okay, and yes, Raj Lakshmi, as I said, that forward contracts they are traded over the counter. So since they are traded over the counter, they are customizable. Okay, but they will carry more risk except for basis risk. Of course, other aspects of risk are there, which we'll see later on. They carry more risk compared to exchange traded contracts because exchange traded are more standardized. Yes, Nitin, maturity date is same as the expiration date. Okay. Now let's take an example of bid and ask over here. Okay. Now forward contracts. So we'll discuss the example based on the forwards on foreign currency because they're extremely popular, right? They actually allow the participants of the contracts to manage currency risk quite effectively. Okay. So forward contracts on foreign currency are extremely popular. So let's now explore this example of forward contracts. Let's say there are two parties. Now, before that, what we can do is we can just see this table first. Okay. So this table gives you the bid and ask prices for spot rates as well as forward rates over different time horizons, say 1 month, 3 months, and 6 months. So what is the meaning of these two prices? Now the bid price, although this has not been discussed in the curriculum in detail before introducing this example, but we'll discuss this also and we'll see a recap of some currency notations also, a review I'll say. I'll not say recap because it is discussed later on in chapter number 9, foreign exchange markets. But since it has been used in this chapter, we'll review that also a little bit. Now, what is the bid price? The bid price represents the price at which any dealer is willing to buy the asset. Okay, so it's the buying price for the dealer. Whereas the ask price, the name itself is very clear. Ask. Ask means the dealer is asking this much price to sell it. So basically, this is the price at which they are willing to sell it. Okay, so for the dealer, this is the buy price, this is the sell price. But for the investor, it will be opposite. Okay, because I am buying from the dealer, from the market, and there has to be a broker, a dealer in between. Okay, so for me, this will be the buying price and this will be the selling price. It means if you see very carefully, the buying price for me is a little higher. So if I even carry trade simultaneously without any delay at all, you see implicitly I am paying some money over here. Implicitly I am paying some amount of money. That is actually the commission for the dealer. So dealers, they earn a commission from the difference between these two prices, which is known as the bid ask spread, or sometimes simply the spread. Okay, generally we call it bid ask spread. Okay, so now let's look at the perspective of the investors. Let's say you have this investor A. Investor A is receiving foreign currency. Now, can anyone tell me, if you are receiving foreign currency, what is your concern for the future? You are about to receive foreign currency in the future. Let's say you are a company in India who's providing services to some clients in the US. Okay. And you are going to receive some amount of dollars, say $50,000 after 2 months from the client. So, what is your concern? Very good. Correct. That the concern is that the foreign currency might actually depreciate in value. Okay. There's another investor, B, which is paying foreign currency. So the concern will be opposite. So for A, the concern is that foreign currency will fall or foreign currency will depreciate. But for B, the concern is different. If you are paying foreign currency, if suppose you are taking service from some vendor in the United States, you are based in India, and you have to pay $50,000 after 3 months, your concern will be that the dollar might appreciate with respect to the rupee, so that for every dollar you'll have to pay more rupee. Because let's say the rate today, hypothetically, let's say the rate today is somewhere $85. Okay, 85 rupees, sorry, for every dollar. And after say 3 months, the rate becomes say $87, 87 rupees again, sorry, okay, 87 rupees for every dollar. So it means that what is happening? Foreign currency dollar is appreciated with respect to rupee in 3 months. Earlier it was 85, now it's 87. So for every rupee, for every dollar, you'll have to pay 2 rupees extra. So that is your concern. Now, what is the solution for A in derivatives markets using the forward contracts? What is the solution for A? This is the solution. A can sell foreign currency at the foreign forward exchange rate, locking in the current rate to avoid any kind of losses. Okay, so we'll see numbers also in the example, so don't worry. So understand that this is the solution, that you lock in the current rate so that there is no issue later. And for B, the solution is to buy for foreign currency at the forward exchange rate. Okay, so that you don't have to pay more, you lock in the price, and you don't have to pay more if the currency strengthens. And then, in fact, there is a very systematic mechanism to arrive at the exchange rate prices, which we'll see in detail in foreign exchange markets. And the underlying principle is actually based on the interest rate parity concept. We'll see in detail. Okay. Now, one thing you see that generally the forward prices, they are actually not equal to the spot prices. Okay. And as I said, the method for calculating forward prices, it will be discussed in foreign exchange markets chapter. Now, this solution that we said, when you say sell foreign currency at the forward exchange rate, it means this is a short position. This is taking a short position in the forward contract. And this is taking a long position in the forward contract. Okay, so we'll see numbers also. As I said, no need to worry at all. But before we see the numbers, let's do a quick review with respect to currency changes. Okay, so we can do a very quick review. And as I said, this will be discussed in detail in FMP 9. But since this idea has been used in this chapter, we can just discuss it briefly. Now, I'm focusing more on this part over here, the spot price. Okay. See, if you have to quote a single price, of course, there are two different prices. You have bid price and ask price. But generally, if we are talking with each other, and if we have to just say, okay, what is the exchange rate today? And we have to take a single price. What is the best option we have? Correct, the average. Very good. So that average is known as the mid-market quote, mid-market spot. Okay. So if it is 1.1769, okay, I've tweaked the numbers a little. In the previous example, it was 1.1771. So just to make the average simpler, I've taken it as 1.1770. Okay. What is the meaning of this in terms of the relationship between euro and dollars? Because this is the table for euro and dollars, as I said earlier. So it means that approximately $1.1769 are required to buy 1 euro. Okay. Now, those of you who are not very comfortable or are not aware with appreciation or depreciation of currency, I'm explaining it once again using this example. See, appreciation means what? Appreciation of euro means that in the future, more USD will be required to buy 1 euro. As of now, 1 euro, if you want to buy, you can buy using this much USD. But if euro appreciates, probably more USD will be required to buy. So more than this will be required to buy 1 euro. And what is the meaning of depreciation? Depreciation means in the future, it will become less. So less USD will be required to buy 1 euro. That is the whole idea behind currency appreciation and behind currency depreciation. Vedant is asking if the bid and ask rates vary dealer to dealer. The mid market spot would also vary across the definitely yes. Okay, but yeah, even the bid and ask rates don't vary too much across dealer to dealer. But yeah, definitely they vary to a little some extent because even with banks, we see that the rates are not 100%, same with different banks for the same currency pair, right? So yeah, it is possible. Okay, now let's take an example. As I said, we'll crunch some numbers also. So we'll just explore this scenario, and in this case, there are two companies, company B and company A. Now, company B takes a long position on 1 million euros for 6 months. It means that it agrees to buy euros in 6 months at the forward rate. And company A takes a short position. So company A agrees to sell euros at the forward rate after 6 months. Now, let's take example and let's take that, okay, this is our base. So from the same table, this is the current mid-market spot, okay? Now, if euro appreciates, it means that it will become higher than this. So let's say euro appreciates to this number, $1.25 per euro in 6 months. What will be the payoffs for A and B after 6 months? Okay. So what will be the payoff for A and B after 6 months? Remember, B is going long because this was the concern for B, right? B was having this concern, so B is going long. So if B is going long, guys, can you tell me whether we are concerned with bid rates or ask rates for B? Quickly tell me if B is going long.
Ask, ask.
Very good, very good. Because very good. Because this is the buying price for B and this is the selling price, right? Very good. So since B is going long, so it means we'll consider the buying price. Okay. So this is something which initially some candidates might get, but of course with practice, you will be very clear on this thing. But initially, sometimes even after the class, you might be, getting confused. Okay, this is the buying and this is the selling. But no, this is the buying For dealer, not for you. For you, this is the buying price. So for B, this is the buying price. So we are concerned with these prices. So let's talk about 6 month forward. So for B, since both the parties are engaging in 6 month forward actually, maybe with different counterparties. I'm not saying that A and B are dealing with one another only, but yeah, it is possible that they can deal with one another also. That is how the example has been framed. There's no harm if they deal with one another also, because the amount and everything I have kept same. Okay. So since we are talking about 6 month forward, so basically we are concerned about these two rates over here. So for B, we are concerned about this rate 1.1948, and for A, we are concerned about this rate 1.1944. Okay. So let's see what is the payoff for company B. This is the payoff for company B. This is the current rate after 6 months. This is the forward rate because this was the rate that was agreed between the two parties. Okay, so this is the payoff for company B. Is the payoff for company B clear?
Sir, 1.25 is not the forward rate.
1.25 is the current rate after 6 months, the spot rate after 2 months.
Spot rate. Okay.
Yes. Okay. Current spot rate was 1.1769. Okay. After that, euro has appreciated after 6 months. So after 6 months, the spot rate is $1.25. Okay. Now, since it was agreed that this will be the rate, okay, which will be paid by B to go for the long position to buy the euros. So it means that
Loss.
B, no, it's actually a profit because see, B is able to buy euros
Oh,
at
okay.
a lesser price, correct?
Okay. Yeah, yeah.
Okay. So that is why you are having a positive payoff,
Yeah.
$55,200.
Mm.
Okay. Because the market rate is 1.25, whereas B, based on the agreement of this forward contract, is able to buy this euros at 1.1948.
Yeah.
Okay, which means it is able to buy at a lesser than market price. So obviously there's a positive payoff. So B benefits from the appreciation of the euro because of its long position. Okay. Now can you tell me what about A? A will be in a loss or a profit? Loss. Very good. Now again, sometimes candidates, in a hurry, they might, say that okay, since for the company B, the profit is or pay a positive payoff is 55,200. So for company A, it will be negative 55,200. No, that's not correct because of the bid ask spread. Okay, because there is a dealer in between who's taking commission from both. Okay, so for A, which rates are we concerned with? This is the rate because A is in the short position, right? So A is able to sell at this price, 1.1944. Okay, so for company A, this is the payoff, negative 55,600. Okay, so there's a difference of $400 in magnitude between them, which you can say the broker is taking equally from both. The dealer is taking equally, say, maybe $200 from B and $200 from A. That's it. Okay, so this scenario, it highlights how the forward contracts they work for both long as well as short positions. Okay, and you can say this is a uh, you can say this is a play where you are having transfer of risk and reward between the two parties based on different kinds of currency movement. Now let us take another example where instead of appreciating, the euro depreciates. So in this case, tell me which party will be at a loss, at a negative payoff. Which party? Correct. Very good. It will be B. So this will be the negative payoff for company B. And for company A, it will be at a positive payoff situation. It will be the payoff will be positive. So for company A, this is the profit, 94,400. Okay, fine. Now let's look at some very, very interesting graph which highlight the payoff structure of a long position. We start with this payoff structure of a long position in the forward contract. Okay, so payoff profile is given where the investor is agreeing to buy an asset at the agreed upon price, which we'll denote as K. Okay. the strike price, or in fact the forward price on that particular day. And ST is the asset price, the underlying asset price over here. Y-axis represents the payoff, X-axis represents ST. Now the payoff for the long position is calculated. You can see it's simply a straight line. Okay, so the equation will be very simple. The payoff is actually calculated as ST minus K, where what is ST? ST is the price of the asset at maturity, S capital T, and K is the forward price, as I said. Now let's
Strike
take an
price.
example. Yeah, please go ahead.
Is that strike price?
Which one? K, right?
ST. No, no, ST.
No, ST is the underlying asset price at maturity. So if the we can take an example, let's say when you entered into the contract, the forward price at that time, that was the agreed upon price, the strike price or the exercise price of the forward contract was 50. But once the contract expires, the price of the asset is 60. Okay. So you have to settle it now. Okay. So since the strike price or exercise price was 50, it means that the long position can buy the asset at 50 even though the market price is 60. Got it? So this is the current market price at maturity, that is ST, the underlying asset. That is why I say it is the underlying asset price. Got it? Is it clear?
Yeah.
Okay. Just like in the previous case, underlying asset was the exchange pair, the currency pair USD Euro. Okay. So in this case, ST can be anything. It can be a commodity. It can be based on whatever the contract is based on. So if K is 50, ST is 60, the long position has an advantage because the long position can buy the same asset for $50, which is selling in the market for $60. Okay. So it's very clear that the payoff is positive. 60 minus 50 is equal to 10. But of course, if the value of ST was say 40, the payoff will become negative. Okay. Now, okay, what we can do is some ideas like break-even point and everything we can discuss. Again, I'll replicate this image later on so that the idea becomes even more clear. As of now, we can see the short position first. So for short position, can you tell me if for long position the payoff was ST minus K, what will the payoff for short position? Very good. K minus ST. Perfect. Okay, so it is K minus ST in this case. Okay, fine. So again, we can take an example. If K is 50, ST is 60, the payoff is negative 10 per unit. Okay, so as I said, I'll replicate this diagram, both of them. So the same diagram I've replicated over here. Now, K is actually your break-even point also, because at this point, the payoff is equal to 0. So when ST is equal to K, so let's say at maturity of the forward contract, the asset price was also 50. So there's no payoff. 50 minus 50, 0, finished. Okay. And again, for the sake of simplicity, we are not considering any commissions, no broker dealer in between. Okay, so it's just a contract between the long and short for the sake of simplicity. So this is the break-even point. Now let's see some more payoff characteristics. Can you tell me, just by looking at this diagram, what is the maximum potential gain? Theoretically, again, not practically, theoretically. What do you think is the maximum potential gain?
Infinity. Oh,
How much? Correct. Correct. Infinity. Absolutely. So maximum potential gain, if you see that the graph is going continuously up, right? To the northwest. There is no limit theoretically. Of course, practically it is not possible, but theoretically infinite because the price of the underlying asset can rise theoretically without any limit. But is there any limit to the maximum possible loss?
yes.
What is the limit? Can you tell me?
Zero. Oh,
No, 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 no. Zero is the break-even point. There is
Okay.
a loss also. You can see over here. This
Minus
point is
50,
the
sir.
loss. Don't say the premium because as of now there is no premium. Use
The
another
profit
word,
free.
proper word. There is no premium as such. Premiums are in options. There is no premium for forward contract actually. Very good, Vedant. It is actually K. You should not say negative K. Negative K, correct. Aruna, we have to look at the y-axis over here. Because of the y-axis, if you see, this point is actually negative K. Okay. But this point is negative K means payoff is negative K. So if payoff is negative K, the loss is K, right? In terms of loss, if we say that the payoff is negative 50, it means that the loss is 50, right? It does not mean that the loss is minus 50. The loss is negative. Loss is a positive number in this case, okay? So maximum possible loss is equal to K because this point over here is clearly minus K. Very good observations from all of you, okay? Yes, Lucky is asking in the previous example, can you please elaborate about? Yes, yes, absolutely. See, underlying asset, again, I'm saying, what is the meaning of underlying asset, Lucky? Underlying means the asset upon which the prices are being derived. Yes, Rajan, I'll explain, but I'll first, I'm just going back to answer Lucky's doubts and I'll come again to that slide and explain again. Don't worry. So, in this example, the underlying asset is this currency pair EUR USD. Not only EUR USD, this currency pair. Why this is the underlying asset? Because see, forward contract in itself is just a contract. There is no, you can say, the contract will expire, correct? But the underlying asset pair, this EUR USD, will not expire. For example, if you have a stock and if you have a forward contract on that stock, hypothetically, the forward contract will expire. The 6 month forward contract, this 6 month forward contract, which is having these bid and ask rates, it will expire after 6 months. Okay, it will expire after 6 months. Maybe a new contract will come into picture, which will be a new 6 month contract. But the previous 6 month contract will expire. But this spot, this underlying asset will always remain. Correct, Lucky? So in
Yes, sir.
this,
But in the video, na, it was been told like the euro is the only underlying asset
no, no, the
in the
pair is the
recorded.
no. Actually, why we say generally sometimes based on convention because since the base currency is a dollar over here, so that's why for the investor from the perspective of an investor who is actually in the United States, okay, the euro becomes the underlying asset. That's why. Okay, but let's say from the perspective of a trader, from the perspective of a trading book of a bank, if you have to represent the underlying asset, you'll say that it is actually the USD, the pair EUR USD, which is actually the underlying asset. So it is all about context and perspective, Lucky. Okay, it's actually a good observation from your side. But again, it's all about context and perspective. There is no harm, and it is not at all wrong to say that euro is the underlying asset. But in that case, we need to understand that maybe we are talking from the perspective of a US investor who's actually investing in euros. So for that person, euro is the underlying asset. Got it, Lucky? Clear? Okay, fine. Rajan, you wanted me to explain, I think, the maximum possible loss, if I'm not wrong. Correct, Rajan? This part, yes. So I said that, see, if you look at the y-axis, is it possible that the asset price, any underlying asset, can it go negative in the price of any stock? Can it become negative? The price of any commodity, can it become negative? No. So it means that there is nothing, this line cannot go beyond this limit, correct? At best, the line can reach the y-axis. It can never cross this part, correct? It can never cross the y because asset price ST cannot become negative. So what is the maximum loss in this case? The maximum loss in this case will be the case when the asset price drops to zero, when ST is equal to zero. And in that case, you can clearly see from the graph, when ST is equal to zero, this point is minus K. Okay, because it's a line which is having a slope of actually 1. So this and this are actually equal. You don't need to figure that out. from the diagram, it should be very clear, right? That if this is K, these and this part and this part are clearly equal, right? So is it clear, Rajan, now that this will be the maximum loss? Great. Now, just a quick math recap I want to do for all of you, even though it's not a part of the FRM course, this slope part and all, but uh, I think it's a very good way to understand the graphs. If you understand the idea of slope, even here also, we have done slope in regression. So you'll ask that, that slope was already covered in regression chapters, and where does slope come here into picture? Okay. So we'll see what is the idea behind slope in this particular case. Uh, do you remember the definition of slope from linear regression? It was the change in y for 1 unit change in x, right? So exactly the same way we can define slope in this case also. Slope is the change in payoff for 1 unit change in ST, because payoff is y, ST is x. Okay. So let's say if ST is currently 60, but if suppose you have not hit maturity, you're just at maturity, maybe a few hours are remaining, then in the final hours of maturity, ST changes from 60 to 61. So obviously payoff will also become 11. So it means earlier payoff was 10, now payoff is 11. Okay. So there is a 1 unit change in payoff for every 1 unit change in ST. ST changed from 60 to 61. Payoff also changed from 10 to 11. So can you tell me what is the slope in this case? Anyone who can tell me what is the slope? I said there is a 1 unit change in y for 1 unit change in x in this case. So obviously the slope is 1. Very good.
One.
Very good. The slope is equal to 1. Okay. Now it becomes again these mathematical ideas, if you understand, your job will become very easy later on. One more idea I just want to quickly recap from school days. And this is okay for even those who don't remember these things. So you'll be just able to recollect only this idea, nothing more than this. Now, when we talk about slope, it is always a good idea to consider what angle this line is making with the positive direction of x-axis. Very good, Vedant. That angle is actually, in this case, the slope is 1. The angle also, it's clearly evident that it's a 45-degree angle, right? And this slope from school days, from basic trigonometry, if you remember, we could derive this slope easily using the tan theta for that particular angle theta, which is made by the line with the positive direction of x-axis. Okay, and of course there is another other aspect also in the counterclockwise direction, but I'm not going to introduce it for the scope of for making this more simple, I'll say. So since this angle is theta, so the slope you can measure as m is equal to tan 45 degree, which is also equal to 1. Okay, because this idea of tan theta is only derived using this logic only. So whether you use the trigonometry logic or you use the simple logic of this definition of slope from regression, you will come to the same conclusion that slope is equal to 1. So again, I'm saying, even though this is not a part of the curriculum, but I would still request, I would in fact urge all of you to just understand this part. Okay, it will make your job easier. Let's go to the short position. So this was the short position. So the break even point is of course the same. Now, the maximum potential gain. Can you tell me what is the maximum potential gain in this case?
K minus O. Sorry. K.
K minus
K.
K only. K minus 0 actually, if you see K
Yeah.
only.
No.
Correct.
Yeah.
Because you cannot cross 0 on the left side. Okay, you cannot have negative asset prices. So payoff, the maximum can be K minus 0, which is K only. Okay, so this is your maximum potential gain. Okay, so this, of course, this coordinate will be K over here, clearly K. And what is the maximum possible loss for this case?
Infinity.
Very good. The maximum possible loss is infinity. Very good. Okay. So these ideas, these characteristics, you should try and understand as much as possible. Lines you should try and analyze. And if you consider slope of this line, the slope will be -1 in this case. Okay, you can clearly see, you can analyze it the same way. You'll find that the slope is -1, and which reflects that for every 1 unit change or 1 unit increase in ST, the payoff actually decreases by 1 unit. Okay, so again, if you want to analyze it using some trigonometric ideas, okay, I think it says there is some issue. Just a minute. Yeah, there was some issue. I think it was lagging. I think it's clear now. The screen is visible, right, to everyone? The screen is still visible? Okay. So again, if you want to use the angle idea from trigonometry, this angle you're more interested in, this angle is very good, Vedant. It's actually 135 degrees, and tan of 135 degrees was also equal to -1. So everything becomes consistent. There is no inconsistency as such. Now let's come to futures contract.
So, sir,
Yes.
one more question. So, in this case, what we are saying is if ST will be zero, then our maximum profit will be 50, right?
Correct. Absolutely. Absolutely correct. If S is 0, then you are reaching the point of maximum profit, which is 50 in this case. Absolutely.
Yeah.
Okay. So let's discuss in brief futures contract. Now, forward contracts, we discussed that they are over the counter, where terms were customized between the two parties. Futures contracts, on the other hand, even though they offer a similar payoff structure to forward contracts, but the most important distinction is that they trade on a regulated exchange. Okay, so you need to understand that forward contracts, they are most popular for exchange rates like the EUR USD pair that we discussed. Even for interest rates, you have forward contracts are more popular. Okay, but futures contract, they actually trade on a much wider range of underlying assets. You can have commodities, you can have stock indices, even different in other indices also, stocks, a lot of things you have for which futures contracts can trade. Okay, so by trading on this exchange, the futures contract, they benefit a lot from standardization, transparency, and a reduction in counterparty risk. And we'll see the distinction in details in the last slide. Okay, today. And futures, we have a separate chapter. In fact, the next chapter that we're going to do today is going to be futures contracts only. Okay. Now, what are options? Options are derivatives that gives the holder the right but not the obligation. Remember, the forwards and futures, they are actually obligations, but options, they give the holder only the right but not the obligation to buy or sell an asset at a predetermined price in the future. Okay, they trade on exchanges as well as in the over the counter market. So to understand options, again, I'm constructing a very layman kind of example, particularly for useful for those who are dealing with these things for the first time, and also useful for those who already know these things. So Nitin is asking a question. Forward contract underlying is always currency. I said not always. See, I said more popular. Currency and interest rates, actually, Nitin, they are more popular in forwards. So for forwards, the underlying can be currency, can be interest rates, but there is no harm in having forward contracts. In fact, there is no restriction in having forward contracts in any instrument for that matter, even on commodity stock, anything. I mean, if two parties are agreeing to have underlying asset as something, who's there to stop? Who's the one to stop them, right? I mean, you only need to have an intermediary based on the OTC regulations. Also, they need to follow regulations, and then they can go for it, no problem. Okay, so in this case, as I said, we'll construct a very layman kind of example. Let's just say that I give you a coupon, okay, that allows you to buy a watch, say an MF watch, I call it, from my store. Okay, so for $2,000. Okay, now you have the right to buy the watch at this price, regardless of the actual market price. Okay, and I tell you that the the last date at which by which you can exercise this option. Let's say today is say 1st of January. I give you a New Year offer that okay, this is the New Year offer from at my store, and the last date by which you can use this coupon is 31st of March 2025. Okay. Now, before we analyze the scenarios in detail, in fact, I'll do one thing. Before I'll ask this question after we analyze the scenarios to start with. Okay. Then I'll ask this question. Let me first analyze the scenarios. Say on 31st of March, you come to my store and you find that you don't come before 31st of March. I have given you the option. You can come on or before 31st of March. But you come on 31st of March, last day, and you come and see that on 31st of March, the price of the watch is 2400. Will you use this coupon?
Yes.
Yes. So coupon is used. What is your payoff? Correct. Your payoff is
400.
400. Okay. So you save $400. Okay. But if the market price of the watch on 31st of March is $1,800, will you use this coupon?
No.
No. So what will be the payoff in this case?
0.
Zero. Okay. So I think there's a mistake over here. I think this will be actually equal to zero because you're not using this. Okay, Lucky. So it's not actually 200 or negative 200, Lucky, because you're not using it. So there's no payoff. Got it? It's not a forward that you have to oblige. That is the difference between this and a forward. It's a coupon. It's your choice. You want, you can use it. You don't want, you leave it. Because why will you use this coupon and buy the watch for $2,000, Lucky, whereas in directly in my store the market price is 1800. You can buy it for 1800 from my store directly. Why will you use this coupon and buy it for more than a market price when you have the option of not choosing the coupon? Okay, Lucky, is the idea clear? That the payoff will be zero, not negative 200. Okay. So Aruna is asking why to correct. Absolutely. Why to buy at a loss? Okay, when you already have a better price, you should say, not a profit, Aruna. You already have a better price because you profit will be the case when you are able to buy at even a lesser than market price. But at that point in time, Aruna, if you are buying at the market price, no profit, no loss, nothing at all. But still, it's a better price than 2000, right? The market price itself is a better price than 2000. So no profit, no loss from the market perspective. So why to buy at a higher price? Absolutely. Why to get a loss? Now, let's relate this. Okay, Vedant is asking if there is always an option with us to exercise at a time when it's profitable, wouldn't it always be a loss? Absolutely, Vedant. Very, very critical question, and that is why we'll discuss some things with respect to its value. And that is why I said that I will ask this question. I was asking a question before we discuss these scenarios, but first I wanted to discuss this scenario, and it's very good that this question has come to your mind. And I think the main motivation, the main objective of me waiting for the discussion of the scenarios to ask my question is actually, uh, I think, fulfilled with you raising this question. Very good. So first, let's relate it to the option terminologies first. Now, this MF watch is actually your underlying asset. Okay. Let me just, yeah, select the laser pointer. So this is the underlying asset. In option terminologies, this is similar to the strike price or the exercise price. And in option terminology, this is similar to the expiration date. Now, I said that I wanted to ask a question which will answer Vedant's question also. I'll give the answer also. Now, since and Vedant,
There is
I'm
always
asking
an
this from
expiration date, right, sir? So that is not always an option to exercise at any time, right?
No, as I said that I gave you this option that you can come on or before 31st, but you decided to come on 31st. So this also we'll discuss later on. There are two kinds of option, European and American. European option give you a option only to exercise at the expiration date, whereas American options give you the option to exercise on or before the exercise date. Okay, so we'll see that later on also. Now, Vedant, you asked that shouldn't it always be a loss for the issuer? So let's reverse the perspective and let's consider the same thing from the perspective of the option buyer, this coupon buyer. So think about it. If I have given this coupon to you, do you think that this coupon has some inherent value because you have the potential to provide a benefit if the market price moves in your favor? Okay, but if the market price moves against you as a buyer of the coupon or as a holder of the coupon, you don't suffer any loss. You just let go of that coupon, you don't exercise it. So, don't you think that this coupon has some inherent value? I may give it to you as a gesture of goodwill for free, but do you think this coupon has zero inherent value for the buyer? I'm asking because you never are at a loss. Either you are at a profit or zero. So, do you think there is some inherent value? Question
Yes,
open to all. Yes, absolutely
yes,
yes.
intrinsic value, sir. Yes,
Yes, there
intrinsic
is some
value.
intrinsic value, there is some inherent value. And that is why it does not, yes, Aruna, absolutely, it is preventing you from a loss. So, there is inherent value. And that is why, since from my perspective, I am the store owner, I am the issuer of this coupon. So, from my perspective, it is either a zero profit or a loss because if you use the coupon, you can have a positive profit. Okay, but I don't have anything positive. Okay, you have a positive payoff. I don't have a positive payoff. So it means that it does not make sense for me to give this coupon free to everyone. Okay, Vedant, is the idea clear? I cannot suffer this loss all the time, right? I mean, that is why I will charge. It makes sense to me because I'm taking a chance. Okay, although as a gesture of goodwill for my customers for my promotion, I may give this coupon for free sometimes. That is okay because that is a kind of advertisement only for me. But keeping that aside, there is some cost associated to that coupon. Let's say this coupon, I don't give you this coupon. I may give you as a gesture of goodwill, but you don't buy it from me. I gave it to someone else. Say I gave it to one of the candidates in this particular batch, say candidate A. And candidate A does not want to use it. Candidate A goes out of station. Candidate A is not able to come to my store because the condition of using this coupon is that you have to come to my store. So candidate A cannot come to my store. So candidate A feels that okay, I have this coupon which has some value. Let me see if I can sell it to someone else. So candidate A decides to give this coupon to candidate B, and candidate B is happy to give $10 to candidate A for that coupon. And this is similar to option premium. Okay. The options do not sell for free. The options have an inherent cost associated to them because they are protecting you from a loss. They are kind of an insurance which will definitely carry a inherent cost. That is known as the option premium. Okay. So is the idea clear regarding option premium? And since forward contracts are obligation, that is why there is no premium, there is no inherent cost to enter into a forward contract. You can enter into a forward contract without any cost.
But again, that premium will be for the uh, party A, right?
Premium will be for the buyer of the coupon. Correct. For the buyer. For party A, the premium will be paid to party A. Absolutely correct. By party B. Absolutely correct. Okay, because party A is selling the coupon, party B is buying the coupon from party A, Initially, if I had given the coupon to party A, maybe I had given it for free or I had sold to party A also. In that case, party A was the buyer or the holder. But after that, once the trade is taking place, for every trade, we need to see who is the buyer. And the buyer of the coupon will pay some money to the seller of the coupon because it has an errant cost. And because of this extra incentive of $10, Vedant, I am taking a chance which can lead me to a loss also. Because as a seller of the coupon, I never get a chance to face a positive payoff situation. Okay, so I think this answers your question in detail, right? So because my incentive, Vedant, is this $10 only, because I'm always at a loss or at a zero payoff situation. Got it? Okay. Now let's do one more thing, because in forwards contract case, we were only dealing with payoff because there was no cost involved. So payoff was the same as profit earlier. But in this case, will the payoff be same as the profit? If there is an extra cost of premium, and if I ask you that in this case, if the payoff is 400, please calculate the net profit for the holder. Exactly. Very good. $10 of cost will be deducted from the payoff, which will actually give you $390 of net profit. So profit and payoff are different in options, but they are same in forwards. Okay, we are again ignoring all the dealer broker commissions and everything. Margins are also being ignored. Interest on margins are also being ignored. You will see margins in the next chapter. Okay, anyways, now in the second case, can you tell me what will be the profit in the second case? If payoff is zero, what is the profit? Very good. The profit is negative 10, because whatever cost you had paid to acquire that coupon, since you are not gaining anything from that, you actually forego your cost. You completely let go of that, and whatever, yes, the coupon price that you paid, absolutely, Aruna, that is gone. Okay, fine. Now, see, one thing which I said is very, very important, that it gives the holder only the right to buy. So this part sometimes is not very clear to many candidates. That is why I will emphasize this not only in this slide, but I think repeated number of times in subsequent slides also, so that you can get it very, very clearly. Now, before we continue, Vedant is also asking, there would be an opportunity cost associated with, definitely yes. There would be an opportunity cost associated with that, with the time of exercising the option. Absolutely. But I think a straightforward decision, Vedant, is that even if it gives a small positive payoff, since you have already paid the premium, you always exercise the option when it gives you a small positive payoff. And you never exercise the option if it gives a less than or equal to zero payoff. That is the straightforward rule in this case. Okay. Now, I said that this point I want to repeat again and again. So this right which I was talking about, this right is available to the long position actually. The long call. Now there are two kinds of options.
Oh,
Okay. Yes, please go ahead. Nitin, you're asking something?
sorry.
Okay, sorry. So a long call option. So there are two kinds of option. You have long call option. It gives you the holder the right to buy. You also can have the long put option. It gives the holder the right to sell the asset. So in both cases, whether it's call or put, the right is with the long position. Okay, don't worry, we'll see call options and put option in great detail in subsequent slides, and there are multiple chapters dealing with this concept. Okay, so subsequently everything will get clear. What are calls, what are puts, we'll see. Let's start with a basic example. So yeah, so first let's see that the same point is being repeated. There was no cost involved to enter into a forward contract, but entering into an option contract requires a price or the premium which has to be paid at the outset. Okay, so this table actually gives you the call option premiums on IBM stock on June 11, 2018 with different expiration dates. So it represents the price of the option kind of, okay, because if you take the mid market between these two, it is actually the price of the option, upfront cost or the premium of the option, and it depends on several factors. Now, if you see the call option over here, you are seeing very clearly that as the strike price of the option is decreasing, okay, as the strike price of the option is increasing, sorry, the strike price as it is increasing, the option premium is actually decreasing. If the strike price is increasing, the option premium is decreasing. For example, if you see, let's say, any case, let's say at k is equal to 140. Okay, if you see this option contract, September 21, 2018 expiration. So at k is equal to 140, the bid premium is 9.70, whereas at k equal to 155, the bid premium falls down to 2.14. Now, why does this happen? We can think of it in very, very simple terms. Suppose if you have a choice to buy something at 140 or 155, what will you prefer? Of course, naturally, you will prefer to buy at a lower strike price. Correct, Lucky? Okay, no one wants to buy expensive. Absolutely. Okay, so naturally, if you will prefer to buy at 140, so that's why, correct, Vedant. That's why the options with a lower strike price will become more valuable. They are more likely to be exercised profitably, right? That's why they have a higher premium. Okay, so this relationship is no surprise at all, and it is true for all the cases. You can see that. Now let's talk about premium and time to maturity relationship. Okay, see, one thing is again very clear that the call option premium increases as the expiration date is further away. So as the expiration date is further away, as the expiration date increases, the option premium also increases. So again, at this in this entire row, you can see it is continuously increasing. Now, why does this happen? See, the more time an option has before expiration, the higher the chance that the underlying price will move in your favor. It's all about time value of option. So options with longer time horizons are like giving yourself more time to make a better deal. That's it, which will make them more valuable. Of course, they may go the it may move against your against you also, but still the probability of giving yourself more time to make a better deal, of course, it is increasing with time. The probability of giving yourself a better deal with time increases. Now, Aruna says directly proportional. See, now, although your understanding is correct and you are not wrong in saying proportional, but when you say these words directly proportional, the mathematical, technically and mathematically, if you remember the definition of directly proportional, correct, Aruna. Yes. So you should always directly related is a perfect word, directly related. So, and see, these things are not, they won't matter from the point of view of the exam, not at all. So your understanding is absolutely solid. But I always emphasize this because when you are speaking, you should always use technically correct words as much as possible. Okay. And this is actually a habit which you need to develop. And this is true for everyone. Everyone, if you try to speak for the first time, explaining all the concepts when you are reading, there will be these kind of errors where your understanding will definitely be correct, but the choice of words may not be 100% technically accurate. So try and make sure that your choice of words is also better. Okay, so call option premium actually decreases with higher strike prices and increases with time to expiration. Now, if you see put options, for put options, if the strike price is increasing, the option premium is also increasing. Okay, so makes sense because If you have the right to sell something at a higher price, 155 versus 140, what would you prefer? Of course, you would prefer to sell at a higher price that is more favorable. That is why options with put options with higher strike prices are more valuable. Remember, put options give you the right to sell. So if you are having the right to sell at a higher price, it is more valuable to you as compared to the right to sell at a lower price. This right is more valuable to you. That's why this option is more valuable to you. Okay. For expiration, the idea is completely same as the call options, because as the expiration increases, the option premium will always increase because it gives you more chance, more time is available to you, greater opportunity for the asset price to move in your direction, which makes the asset put option more valuable. Now let us see the payoff structure. You can see it's quite different from the forward option payoff structure, which was clearly linear. This is non-linear.
Mickey,
Okay.
just one question, sorry.
Yes. Yes, yes, please go ahead, Nitin.
So the previous slide, I think what we are saying is that the expiration date, this relation, right, in case of option and put is
Call and put both.
call and put up is same, right?
Same, absolutely. They are both direct relationships. Okay.
Basically, what
Whereas,
option premium.
whereas in case of strike price, this is a direct relationship, but this is a indirect relationship.
Okay.
Okay. Because for both call and put options, more time means more time to have a better deal. That's it, Nitin. Clear?
Okay.
Okay. So let's analyze. So this is your exercise price. ST is the asset price at time T. So if ST is greater than K, the right is exercised. Okay. And the payoff is ST minus K. Okay. It's profitable in this case. But if ST is less than or equal to K, the option or the right is not exercised and the payoff is clearly zero. Now, mathematically, if I want to combine statement 1 and statement 2, the payoff structure along with these inequalities, mathematically, if I want to combine these two and put them together in a single statement, we can do this using the max function. Payoff is equal to max st minus k comma 0. Okay, because it's very clear when st is greater than k. So obviously this is the max because st minus k will be positive. So this is max. So you choose this. And if st is less than equal to k, then 0 is the max. Okay, because either this will be negative or 0. So 0 is the max. So in that case, payoff will be equal to 0. So that's why this max function beautifully combines these two conditions into a single statement. Okay. So if this is the payoff, profit will be nothing but payoff minus premium. Profit will be nothing but payoff minus premium. Now again, can you tell me what is the theoretical maximum payoff? Theoretical maximum payoff?
Infinity.
Correct. Infinity. Very good. It is infinity. And minimum payoff?
A.
Minimum payoff is?
E.
0.
0, not K in this case. See, we are not going down at all. For the long position, the minimum payoff is 0. Okay. So be very clear about this. Now, for the short position, the diagram will be just like a mirror image of the previous diagram along this axis, along the horizontal axis. Okay, so rather than, uh, see, I always tell this to all my students that when you consider options, when you start studying options, you should only consider the perspective of long position and you should simply negate it. So make it inverse, mathematically say additive inverse, negative, basically negative of long, and just remember everything from that perspective only. So payoff to short is equal to negative of payoff of long or payoff to long, which is nothing but negative of max st minus k comma 0. Okay. So what is the theoretical minimum payoff in this case? Theoretical minimum payoff. I'm not saying loss or anything like that. I'm saying minimum payoff.
Infinity.
Negative infinity, actually. Okay, because in this case, I said payoff. I did not say loss. So if I had said, if I had told theoretical minimum loss, you would have told infinity. Okay. So that's why I said, let's be try and be technically correct. So I'll also tweak the questions a little bit so that you can understand these subtle differences, although they're not very important from the exam point of view, but these are small but still significant differences, I say. So theoretical minimum payoff is negative infinity. And what is the max payoff for short?
Zero.
Very good. The max payoff is zero, Aruna. Okay, zero. So you can see that this payoff is clearly, declining linearly in this particular segment after K, and it is actually equal to zero constant before K. Now let's go to the long put position. So again, let's have the two equations, the two conditions and the payoff equations. So again, you will exercise if ST is less than K. In this case, payoff will be equal to K minus ST. Why? Because you will always want, okay, see, K is your selling price. For long put, you are getting the right to sell at K. So obviously, you will want the market price to be less than your selling price. Okay, if the market price itself is, say, a higher, you can sell at the market price only. Why will you sell at a lower price at K? Okay, so that's why if ST is less than K, you will sell in this zone. When ST is less than K, you will exercise the right. Payoff will be equal to K minus ST. But if ST is greater than equal to K, option will not be exercised because let's say K is 50 and ST is 60. If market is already allowing you to sell it at 60, will you choose the option and sell it at 50? No, never. That is why you will not exercise the option and payoff will become equal to 0. And again, if you combine 1 and 2, the payoff can be simply max K minus ST comma 0. Now in this case, what is the theoretical maximum payoff? Yes, in this case, the theoretical maximum payoff is actually equal to K over here because ST cannot go negative. Okay, so this is the place that you are bound by. So you can see that for long call, there was no boundation as such. Okay, from the payoff perspective, there is no boundation, infinity. But for the long put, the maximum payoff theoretically, it is equal to K. And what is the minimum payoff for long put? Everyone, come on. Yes, Lucky. We'll go. We'll understand why anyone would take short in the call. Okay, so minimum payoff is zero. Okay. Now Lucky is asking why will anyone take a short in a call? Again, the motivation, the same motivation I said earlier. Same answer. Premium. Okay, let's say you are you have a perspective also. You might say that okay, what premium? Premium is so small as compared to the theoretical minimum payoff that I may get, right? That might be your concern that you are getting only $10 as the premium, but your loss can be say $2,000 theoretically. But see, that is theoretical in nature. You you may have a sense of the markets. You may have your own perspective. Okay, you may feel that no, in this much amount of time, let's say you buy a 2 month option. Okay, you might feel that no, in the next 2 months, even if I am going in a short position in an option, say you are in a short call, you think that no, the prices will not move so much that I will suffer a loss. The prices will be moving very little so that I can just keep my premium and I can just relax. Okay, so this might be the idea. Or even if I have a negative payoff, it will be very small as compared to the premium. So still I'll be in a positive profit position. Okay, Lucky. So that is the reason why anyone would take a short position in the call. And that is why option trading is something which is very risky and we recommend very strongly. We recommend, some of our candidates have asked this question also in previous batches. that yes, 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 I'll explain, Vedant. That is why I said this entire thing will be repeated again and again in subsequent slides. So don't worry. I'll explain once again in subsequent slides. So I was saying that many of our candidates have asked this question regarding the idea, of how should they start option trading and all. See, the first advice that we always give that in the worst case, I mean, if you're speculating on stocks, let's say you don't have much idea, you want to enter the markets, you have not done very strong research of your own, you're just trying to understand the markets, and you are doing a little bit of speculation to understand it. See, for stocks it may still be okay to some extent, but even for stocks you should do a very strong research before you enter. It's better to build dummy portfolios first. ठीक है, even if you go for it, you'll not be suffering a huge loss immediately. Okay, it's very rarely that that might be the case. But option trading is very, very risky. So you might lose a lot of money, okay, because there's a lot of leverage also involved, which we'll see later on in a very concrete example. So that is why you should be very careful while trading options. Okay. So Lucky, is the idea clear? Why will anyone enter into a short position? Because of the incentive of premium. Okay. Okay. It is clear partially. Let's say I am trading in say TCS options. Okay. Say the price of TCS, again hypothetical. I don't remember what is the price exactly. I think it's somewhere around 3,700 or 30. I don't remember actually. Let's say the price is hypothetically 3,700 rupees. Okay. And I trade in options where the strike price is 3710, 3710. The current price of TCS is 3700. Let's say the strike price of the option is 3710. The time to expiration is say 15 days only. So I'm say very sure that the price of TCS might not increase in the next 15 days based on my analysis. Okay. So even if it increases, it may increase say by 10 rupees. It may go to say 3710. Okay, max, or 6 7 rupees max, something like that. That is my analysis. So I take a short position in this option of strike price of 3710. Okay, which means that after 15 days, if the price does not increase above 3710, Lucky, the option will expire worthless. The long position will not exercise. So I will get to keep 100% of my premium. So is the incentive clear now, Lucky? Okay, so that is the idea. That is why you might take a short position. Okay, in layman terms. And of course, there are a lot of technical details associated with it when you start to trade. So a lot of factors will be there. Okay, now short put, just like the mirror image in case of short call. Over here also we have a mirror image in case of short put. Okay, the mirror of long put is the short put. The mirror is the horizontal axis. So payoff is equal to negative of the payoff of the long put position. Okay, what is the theoretical minimum payoff in this case? Very good. The theoretical minimum payoff is negative K. And what is the maximum payoff?
0.
0. The maximum payoff is 0. So I think this is quite clear to all of you. Now, Vedant, you would ask this to explain once again long short for options properly. So let's summarize the different types of option position once again. Now, long call. Long call gives the holder of the option the right to buy an asset at a predetermined price. Okay. Whereas the short call, it actually obligates the seller to sell the asset if the buyer chooses to exercise the option. The buyer is the long call holder. So see, I told this earlier that this right is only available with the long positions. The short is at the mercy of the long and at the mercy of the market.
So he has to always obligate it.
Absolutely. If the long chooses to exercise, the short does not have any choice. The short has the obligation. Okay. Now the long put has the right to sell. So obviously, if the long put has the right to sell the asset at a predetermined price, the short put have
Obligation to purchase.
very good. The short put has the obligation to purchase or the obligation to buy. Okay. So this is the distinction. Now, again, I'm coming to the question. Now, why will the short enter into such a transaction where they only have obligations but no rights? Because of the premium.
Option premium.
So the long positions, they pay the premium to the short positions. And the short positions, they receive the premium from the long positions. Okay. So is it clear, Vedant? Okay, fine. Okay. Now, before we continue, I just want to discuss one more thing. I just want to discuss market outlooks and positions also in this context. Okay. So if suppose you have a bullish outlook means you are expecting the price to rise. Okay. Yes, again, see, I'm telling you, broker only gets the commission, lucky. Broker does not get the premium. Broker does not get the premium unless and until broker itself is the short position. Broker will not get the premium. Okay. The premium will always be given to the short position. Broker will only get the commission. Okay. So if you have a bullish outlook, bullish means you are expecting the prices to rise. In that case, generally you take just a minute. The pen is yeah. Generally, you take either a long call or a short put. So these two are actually generally taken when you have bullish outlook and when you have a bearish outlook. It means that you expect the prices to fall, then you might take a long put or a short call position. Okay, if you want. Now let's discuss the three main categories of traders. You can have hedgers, you can have speculators, or you can have arbitrageurs. Okay. So let's start with hedgers. Who are hedgers? Hedgers, they use derivatives to reduce or eliminate risk exposure. So they aim to protect themselves from adverse price movements in the market. Let's take an example. Let's say you have a US treasurer A. The US treasurer has to pay 1 million euros in 6 months. Again, we have done this earlier. What is the concern for the treasurer?
Change in
Appreciation of euro.
Appreciation of euro. Absolutely. So increase in value of euro or appreciation of euro. This would make the payment more expensive in dollars because the treasurer is US based. Okay, so the domestic currency of this treasurer is dollars. So if euros appreciate, this payment in 6 months will be more expensive in terms of dollars. So what is the hedging solution? See, earlier we have seen hedging solution using the forward contracts. Okay, so that also can be used, and generally I'm telling you, generally forwards are only used by big institutions. Even banks, they generally deal in forward contracts more as compared to option contracts. But since we have already explained how to go for hedging in case of forward earlier, even though we did not use the word hedging, but that was hedging only when the party A and party B were entering into their respective long and short contracts. Okay. In fact, I think party B was long and party A was short in that example. Anyways, in this case, we'll use options, okay, to hedge, even though they're not very popular. Okay. So, what is the solution? The solution is to buy a call option to secure the right to buy 1 million euros at a fixed exchange rate of $1.3 per euro. So this will ensure that even if the euro appreciates beyond 1.3, they can still purchase euro at the agreed rate of 1.3. Okay. So let's discuss some possible outcomes. So if the exchange rate after 6 months is $1.2, will the option be exercised?
No.
No.
Very good. Option will not be exercised because the treasurer can directly buy from the market at 1.2. Why will the option be exercised? Why will the trader or the treasurer exercise this option buy at a higher price? Not exercised. But if the price, the exchange rate is $1.4, in that case, the option will be
Exercised.
exercised. Okay. Because the treasurer can exercise the option and buy it at 1.3, which is lesser than the market price of $1.4. So this protects the treasurer from unfavorable exchange rate increase. Okay.
So, sir,
Again, you
that
have
premium will go to the seller, right? For the
premium will go
option.
to the seller. Absolutely.
Hmm.
Yes. Premium will go to the option seller or the short option position. Absolutely. So treasurer is going long and there is another party on the opposite side who's going short maybe.
And sir, one more doubt I
Yes.
had,
Yes.
that
Yes.
the premium, is it like per euro, per dollar, or is it a lump sum amount?
It is quoted as per unit of the underlying. It is quoted like that, but then you multiply it with the number of units and then you get
Hmm.
the final premium. And also there is
Okay.
one more thing which we need to understand, that when we talk about exchange traded options, there are always standards that are applicable. So for example, in India, I'm not 100% sure about this, but I think in India, most of the option contracts are traded on 100 units of the stock. Many of the option contracts. Okay, many of the options, not most. Okay, you can just inquire this. You can just do some research and just confirm this. But I think it is 100 units only. It may be 1,000, it may be 10,000 also. That's not a problem. But it is actually predefined. And the premium will be quoted based on per unit of the underlying. Then you multiply it with the contract size, you get the final premium. Okay. So next case, of course, you can take another example. Let's say instead of paying, the treasurer had to pay. But there's another party B, which instead of paying, the party B has to receive 1 million euros. So what is the concern? Euro will
Depreciation of
very good.
US
Euro
stock.
will depreciate in value, which will actually reduce the dollar value of the payment that B is going to receive after 6 months if B is a US based company or B is a US based investor. Okay. So, what is the approach? The approach is to go long on a put option. If this is the strike price and time to maturity is 6 months, and if after 6 months the price, the exchange rate is 1.05, the option will be exercised, of course, because the market price is lower. The market price of 1.05 is lower than K. So obviously, the party B will receive those 1 million euros, but instead of selling in the market, they will exercise the option and sell it for 1.2. Okay, so they have locked in their selling price even if they are receiving after 6 months. But if after 6 months the market price is higher than K, okay, if ST is greater than K, option is not exercised because they can directly sell it in the market. B can directly sell euros in the market for $1.25 each. Okay. Now, let's see how these derivatives are very, very attractive to speculators as well. So speculators, they actually use derivatives. Yes, lots. Okay, Lucky is saying lot size is variable for each stock. Fine. So for many stocks, as I said, it can be 100, but for many other stocks, it can be say 1,000, 10,000, even 10,000. Or you can just check for different kind of stocks. You'll find different lot sizes. Okay, thanks, Lucky. So let's just see, as I said, that how speculators they use derivatives. So they use derivatives to take risks with a relatively small upfront payment. So in effect, derivatives act as leverage. So they amplify potential returns and also the risks. So let's take an example over here. Let's say we are analyzing a stock A which has a current price of $40. Call option on this stock has a strike price of $42 with a premium of $3. T is the time to expiration. You have $12,000 to invest. So let's compare two scenarios. Scenario 1, case 1. You buy the stocks directly at $40 per share. So how many stocks you're able to buy? 300 stocks. Okay. Scenario 2. You invest the entire $12,000 in call options. Since the price or premium of each call option is $3, you are able to buy 4,000 options. Okay. So what is the key insight over here? The key insight is that the initial investment is same in both the cases. But the number of positions that you control with options is much higher. Okay, this is the leverage that I was talking about, and this leverage can lead to significantly higher returns if the stock price moves favorably. But it can also lead to greater risks if it moves unfavorably. Now let's see.
So why we have divided by three, sir? I didn't get that point actually.
Because the option price is given as 3. The call option premium or the option price for you is $3. That's why. So if one option is costing you $3, how many options you can buy for $12,000? 4,000 options. Clear now?
Okay.
Okay. Yeah. So this is given to you basically. This information is actually given to you. Okay. And you have $12,000. So using that $12,000, if you invest completely in stocks, you are able to buy only 300 stocks. But if you invest completely in options, based on the price of a single option, you are able to buy 4,000 options. Okay. Now let's take a simple scenario. Let's say towards the end of the option expiration, if the stock price is $50 at time t, then at time t, in case one, the total profit will be 50 minus 40 multiplied by 300, which is actually $3,000. Okay, there were 300 stocks. Okay, so the price of each stock was $40. So this is the profit per unit of stock, 300 stocks. Total profit is 3,000. So is it clear? The total profit on 300 stocks is clear in this case?
Yes.
Okay, so just for recollection, what I'll do, I'll just replicate K is equal to 42 because this was the idea. K was equal to $42. Okay, and C naught was equal to $3. So, and number of options that we got was 4,000 options. So I'm just writing these two numbers over here once again because you'll use it in your calculations, right? So K was 42 and number of options is 4,000. So if I ask you to find out payoff for options and the net profit, how will we do it? See, payoff for every single option will be ST minus K. ST is 50, K is 42. So can you tell me per option, what is the profit? What is the payoff? Sorry, what is the payoff? Let's start with payoff. Per option, what is the payoff?
$10.
10 or 8?
8.
8, right? Because ST is 50 and K is 42. The strike price was given as 42, okay, not 40. See, S naught is 40, but K was 42. This was given to you, okay? So $8. So since you have 4,000 options,
32,000.
total payoff 32,000. Very good. And if I want you to find out the net profit, this is the payoff. 32,000 is the payoff. What is the net profit? How much premium you paid for the options?
3. $3.
3 for each option. So total premium was how much?
3,000.
Actually, entire amount you invested as premium only.
Yeah.
Okay. So this entire 12,000, correct, 3 times 4,000 or actually 12,000, you entirely invested in the premium only. So what is your net profit? 32,000 minus 12,000, which is nothing but 20,000. Okay. So you can see significantly with the same amount of money, significantly you made a much higher profit in case of options. So this is the leverage effect. This allows the speculators to amplify returns with the same initial investment. Ujjwal is asking 4,000 options in this case means 4,000 contracts. Actually, no, Ujjwal, in this case, we are assuming that 4,000 options means 4,000 options only. In this case, that is our assumption, okay? Because if one contract is equal to say 100 such units, then it will we have to multiply it by 100 or for that matter 1,000 or whatever number of units is associated with that contract. But in this case, for the sake of simplicity, we are assuming that this is the number of options. Okay. So again, if suppose you want to see the full evolution across a spectrum of this asset prices in 3 months, we can have a spectrum of asset prices from 30 to 50. So for 30, let me just calculate for 30 over here. So for 30, if you calculate the profit from the asset purchase, if asset price is 30, so now it has decreased. From 40, it has become 30. So this will be your net profit from asset purchase, but you lose your entire premium from options. So you can see, even though, I mean, yes, the leverage effect was very, you can say, nicely giving us returns in case of positive profits, where you could amplify your positive profits. But in case of a negative profit, the losses are also much higher. You lose everything over here. All your money is gone. Okay. So the 4 times the loss of sorry, 4 times the loss as in the case of asset purchase, if you see in case of options. Okay, what about 35? Can you tell me what will be the profit from asset purchase if the asset price is 35? Correct, negative 1,500. And what about profit from options? Will the option be exercised?
No.
Again, the option will not be exercised and you lose your entire money. Absolutely correct. Okay, what about 40? What is the profit from asset purchase?
Zero.
Exactly. And what about options?
Zero.
No. Again, negative 12,000.
10,000, sorry, yeah.
Okay, you lose your entire premium, no gain. So you can see it is very dangerous actually. Just before 40, if the asset price does not move at all, you lose everything. Whereas in case of stocks, you're not losing everything. You have zero, you have lost, you have not lost anything in fact at 40. You've lost completely everything at 40. At 35, you've lost a little. Okay, you've lost $1,500, but for options, the losses are very heavy. Okay, but again, the good part is that once the
Sir,
price increases, your profits from options also increases. This is your break-even point, 45 for options. And at 50, of course, your profit starts to amplify. Yeah, please go ahead.
Sir, so in simple words, can we say that in market we have two options like stocks and options. So if we want to buy stocks, we have to make the payment right away. And suppose if we choose for options, we just have to pay the premium. And in future, depending upon if it is in our favor or not, we can make the payment.
In case of stocks, you are absolutely right. We have to pay the entire amount. But the markets practically for options, they work in a very different way. See, in this case, we are considering only the premium amount, right? But in
Mm.
reality, there is also a margin associated with options for both positions, short as well as long. Okay. And the
Mm.
calculation of that margin also is given in one of the chapters later on.
Okay.
So practically, you have to pay a little more than the premium, or little
Mm.
more, and sometimes even significantly more
Yeah,
than.
but we don't have to pay the entire amount. Like
No, no, no.
I am
No, you don't
paying
have to
twenty
pay the
thousand
entire
dollars
amount
for
of
the
the.
stocks, but I won't have to
Correct,
pay similar amount for option. But still,
correct,
I can
correct.
ensure that I'll get equal profit or more profit in future.
Correct, 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 correct. So
Okay.
for the same number of stocks, for the same number of underlying. So
Mm.
let's go back. See, in this
Mm.
case, why we were paying the equal amount? In both cases, 12,000, 12,000, because we chose to buy higher number of options. But if suppose we only have to buy
Mm.
300 options, we'll only pay
Mm.
$900. Okay. So
Mm.
absolutely yes. Okay. Without any doubt. We only have to pay the premium plus some margin amount. Okay, Aruna is asking, but
Okay.
here we will have an asset. Yes, absolutely. That's the difference. In this case, you have the ownership of an asset. Okay. But in this case, either you are hedging or you are speculating or you are performing an arbitrage trade. That's your objective. In this case, you're owning your asset. Maybe you're going for long term. Okay. And in case of options, you're not owning the asset. Absolutely correct. And in case of futures
But it is
and forwards,
equivalent to owning an option, right?
no,
Anyway, the
owning
seller
an
has to
asset.
sell
No,
it to us.
actually, owning an option is not equivalent to owning the underlying stock. No, it is not equivalent.
Because anyway, he has to sell it to us,
Who has to sell it?
the seller,
No, the seller is not selling the stock. The seller is selling the
the
option.
dealer.
The
Yeah, yeah,
dealer is also
sorry.
not,
Not stock, the
nobody is
option,
selling the
option.
stock. Only option is being sold.
Okay.
Okay. So that is something which has to be very clear that in case of stocks, you are owning the asset. But in case of options, if you're long in the option, you're not owning it. Okay. You're owning the contract, but not the option. That is the difference. Okay. Even in case of forwards, underlying asset is not being owned. Spot is with someone else. Okay. But the contract is being owned.
It's
Okay.
right we are owning actually.
Sorry.
We are only in the right.
Correct. You are owning the right in case of long call option and long put option. You are owning the right. Absolutely correct. Okay. See, parallelly, it is possible that you may also own the stock. That is okay. For example, if I already own a stock and if I want to buy some kind of an insurance against the stock, I can have the stock and I can also buy the put option against that stock. That is okay. That is an independent matter and I can combine both of my positions and my profit diagram can be structured according to my needs. Okay, that is okay. But just in isolation, if you consider that put option contract or call option contract, I don't own the underlying. Okay, correct. Absolutely, Aruna. It is absolutely like betting on a running horse. Just like when you bought that coupon from me from the store for $10, let's say from someone else also, if you're buying that coupon, it is like betting on the price of the MF watch. Okay. Betting can be used of the word, but if say you are not speculating, it will not always be betting. It may also be used for hedging purpose also. Yes, absolutely. This is actually a correct expression. You can say educated betting. But yeah, sometimes that's why I said without knowledge, if you are going, without your research, if you are going, it will be completely like betting. Absolutely. Okay, so you should always go for educated betting. Absolutely correct. If you are speculating, if your purpose is not to hedge or to perform arbitrage trades, even if you are speculating, it should be educated speculation. Okay, fine. So now let's just analyze, yeah, these numbers. So you can see very clearly that on the positive side, you're actually, once the stock price goes even further above 50, you'll find that the profit from options increases more and more. And finally, let's consider the arbitrageurs, also the final market participants. Now, arbitrage involves taking advantage of inconsistent pricing across two or more markets. So we discussed arbitrage in for the first time in Foundations of Risk Management chapter number 6. I just gave a layman definition of arbitrage. So the same layman definition is applied here also, taking advantage of inconsistent pricing across two or more markets. Okay, now let's directly discuss arbitrage in this context in the case of derivatives. Particularly, we'll consider arbitrage in the case of forward contracts using this example. And I will just tell you one thing that in this entire example, the question of how it is being done has been answered very beautifully. So you'll understand the how part. But why it is being done like this, that part has not been answered because unless and until you understand the valuation of forward contracts, you will not be able to appreciate or even understand the why part very clearly. So for this example, focus on the how part and we will discuss the why part in the next class when we discuss valuation of forward and future prices. Okay, this distinction needs to be very, very clear. Let's take an example. Let's say you have an asset providing no income. Current spot price is $50. Annual risk-free rate is given to be 3%, which is compounded annually. And this also we'll see in today's lecture. Properties of interest rate, what is meant by annual compounding, semi-annual compounding, all these things. But for the sake of simplicity, I think all of you must be already aware with the basic compound interest idea. So it's just like that. Okay. So R is equal to 3%. Let's assume that the forward price for this asset in 1 year. So basically the 1 year forward price on this asset is $52. So what kind of arbitrage opportunities we have? Okay. So let's see what are the arbitrage steps. The first step is that you borrow $50 for 1 year at 3% and you purchase 1 unit of the asset at the spot price of $50. Okay. This is a long spot position. We are purchasing 1 unit of the spot asset or the asset in the spot market. So this is a long spot position. You enter into a forward contract to sell this 1 unit of asset for $52 after 1 year because this is the forward price 52. Okay. So as I said, this is the long spot position and opposite to this position will be your short forward position. So that is how arbitrage is done actually. You take opposite position in different markets. So if in the spot you are long, you will go short in the forward. But in reality, as I said, the why part is discussed later. In reality, I mean, practically, it makes more sense to understand the forward position first, whether you should go short or long over here. And based on that, you decide your spot. You should, based on that, you take the opposite position in spot. Okay, I'll explain this in great detail. Don't worry later on. Now at t equal to 1 year, you sell the asset and you get $52. Okay, because that is the agreement that you made based on your forward contracts. Based on this agreement, you have to sell, in fact, this asset at $52 after 1 year. Okay, so you sell the asset, execute the forward contract, get $52. But you remember one thing, you have an obligation still left. What is your obligation? This, you had borrowed some amount, right, from the bank. You had borrowed some amount, correct, Aruna? You have to repay that. So based on a very simple compound interest formula, although we'll study properties of interest rate later today, but even if we don't know that, based on the simple compound interest formula, can I say that this is the amount that I have to pay? 50% plus 3% of 50? In fact, it's actually a simple interest case because it's annual compounding. Okay. So this is $51.5 actually. 3% of 50 is how much? $1.5. Okay. So can I say my arbitrage profit? I mean, I got $52 out of which I only have to pay 51.5. So my arbitrage profit is actually $0.5. Okay. So how part is very clear, how the steps are being done, but why it was executed exactly in this manner, why we borrowed for 1 year, why we entered into the short position. Okay. All these things will become clear in a different chapter. So are the calculations clear? Is the how part clear, the calculations? Just look at this 3 steps. Let me know. Is it clear? Okay, fine. So later on, we'll discuss in hedging as well as in valuation chapter, we'll discuss this idea in detail. Okay, now this derivatives risk, you can just go through the main PDF. Okay, fine. Thank you very much for this attending this session. Now, just one thing before I close. See, introduction to derivatives. This chapter, as I mentioned in the beginning, is just an introduction to the huge world of derivatives, and it is not only relevant from the FRM part 1 point of view, Okay, although the learning, the structure and the flow of information that we have discussed is completely aligned with the FRM Part 1 learning objectives and the FRM Part 1 curriculum only. But this can also be, used as a uh, general video to understand the basic ideas behind derivatives. But the warning over here that I want to give is that in no way this video explains the details of the derivatives anywhere. Okay, so everything was just an introduction. All the details, the payoff diagrams, the profit diagrams, options, forwards, all these things can be extrapolated and they can be analyzed in much more detail. Okay. Yes, absolutely, Lucky. I'll go back to the arbitrage example. I think you're asking in this context only. You asked no risk involved in this. Yes, that is why it is known as a risk. Yes, absolutely. It is actually risk free. So, see, you don't invest any amount of your money, correct, Lucky? So, you can say no risk and even no investment if you see. If the bank is ready to give you a loan, even investment is not required from your side, correct? So, no risk, no investment, and you are able to get $0.5. Now, why it happened? Because although I said that I'll discuss this in detail in another chapter, I'm just going to brief you why it happened, why you were able to get this risk-free profit. Because the forward contract was mispriced as per its or as compared to its theoretical price. The calculation of the theoretical price we'll see later on, but actually the theoretical price of the forward should have matched this number 51.5 to prevent any kind of arbitrage opportunity. Is it clear, Lucky? So yes, no risk involved in this. Absolutely. Okay, fine. So we'll just end this session right now. Any questions from this chapter only?
Sir.
Yes.
So, sir, uh, can we say that stocks are assets that we are supposed to buy right now, but options give us the right to buy the same assets, maybe at premium or slightly a greater amount than premium in future?
Uh, don't say slightly greater amount than premium. It should be much greater amount because generally premium is, see, if you remember that example of IBM stock, you remember the premium
Mm-hmm.
was somewhere around $2, $3, even $10 if the option is quite favorable. But it is possible that the price of that same stock will be $150.
Mm-hmm.
So yes, they allow you, they give you the right to buy the same stock in the future by paying the
Mm-hmm.
by
Okay,
paying whatever the differential is there. Okay. But
got
see,
it.
again, these are all theoretical constructs. Even the
Hmm.
forward contracts that we discussed, futures and the options, these are actually theoretical. Practically what happens? Practically, exercise and the buying of stock and selling of stock generally doesn't take place in the market. Practically, the
Hmm.
contracts are settled in different manners. Mostly, I'll tell you, when you buy an option contract, okay, you
Hmm.
are trading on the price of the option contract only, and based on the price of the underlying they are moving, and you settle the option contract directly in the market only. Generally in the market options are not exercised, so this is a theoretical construct that we have discussed. Practically this, by traders in particular, this is not done. They directly buy the option contract one day, they'll find that okay, the same option contract has now become higher priced, let's sell it now. But the mechanics governing the increase of those prices are completely governed by the theory that we discussed today. Okay, Parth,
Okay.
that's
Yeah.
the idea.
And sir, can you just tell how to differentiate between futures and forwards?
Yes, in fact, there is a very detailed slide in the next chapter today because the next
Okay.
chapter is about futures markets only. There is a
Hmm.
dedicated detailed slide where every single point between forwards and futures has been distinguished. So we'll do that in the next class today only.
Okay.
Okay. Yeah.
Thank
Okay. So anything else, Lucky,
Hello,
from
sir.
your side? You were saying something?
Yeah, sir, I was asking like, can you please elaborate bid, ask, and spread? And
Yes.
in electronic market, like in normal Zerodha
Mm-hmm.
accounts, we bid for the price, and
Mm-hmm.
the trade is executed only when, like, if uh, the same ask is reached, like it's like that.
Actually, I'll tell you one thing. You never bid for the price. Actually, the dealer. So this is the confusion. Let's take an example. Let's take a hypothetical example. Say a stock only. Okay. Say Zerodha. You are trying to analyze a stock. One of the stocks we can analyze, say Infibeam. Okay. Say the bid price hypothetical, again I'm just constructing hypothetical numbers over 16.05, and I think the tick size is also 0.05, right? So let's
Yeah,
assume that the tick size is
0.05.
0.05 over here. Or okay, I'm not considering the tick size also. Let's consider that the bid is 16.05 and the ask is currently 16.10. Okay. So you are not bidding anything actually. The dealer is bidding 16.05 for 1 unit of Infibeam stock. If you want to sell it to the dealer, it means that it is the dealer's bidding price. The dealer has told that, okay, if you want to sell it to me, this is the price I am bidding for that stock. Okay. So it means that this is the buy price for dealer. Okay. And this is the sell price for you. And this is the opposite. So the dealer is asking 16.10 from you if you want to buy 1 unit of Infibeam stock from the dealer. So this is your buying price and the dealer's selling price. Okay. So implicitly, you are, I mean, at the same point in time, if you see, if you execute this trade simultaneously, you will be paying a higher price for buying and you will be getting a lesser price for selling. So 0.05 is the commission that is being given to the dealer, and that is known as the bid ask spread. Okay, Lucky?
Yes, sir. But in general, if we execute equity trades,
Mm-hmm.
then we are the dealer, no?
No, we are not the dealer. The dealer is the broker, can also be the
If
dealer sometimes.
I am selling stocks to someone,
Mm-hmm.
or I am buying stocks from someone through exchange,
Mm-hmm.
so like I am proposing some price, no? Like there is the option for, like, you can put in the bid or ask, like that.
No, 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 no. The bid and ask is already, I mean, see, if you're, there are different kinds of trades. Like, I mean, if you're executing a market order, is it
Yeah,
possible for you to say bid, let's say I bid 17 today and the market price never reaches 17? Will I be able to execute the order?
no.
Okay, so I am not the bidder actually. I am a price taker, you can say. I am governed by the rules of the market only, and whatever bid ask spread the dealers are asking me. So dealer is actually the intermediary who's facilitating that transaction for me.
Good. Then how does the market value fluctuate? Like
It
if
fluctuates. It
the
fluctuates based on demand and supply. I mean, suppose at that particular price which has been bid, okay, or which has been decided, if suppose there are more buyers as compared to sellers at that
Hmm.
particular price, because the price is available, that is 16.05 and 16.1. So at that particular price, if there are 100 buyers and only 10 sellers, the price is bound to increase, and you will get both a higher bid and a higher ask later on. That is the idea. But yeah, it does not mean, I mean, it does not mean that you cannot place orders for uh, a higher price. You can always place orders for higher prices. That is okay. But it is possible that, let's say, you place an order for say $17. You want to sell at 17, okay, and the price does not reach 17, but there are many other investors also who have placed the order at 17. But one thing you have to be very clear, that if there were 100 buyers at say 16.1 and 10 sellers at 16.05, then it means that there are more number of buyers as compared to sellers. Okay, so the price of both the bid as well as ask price is bound to increase. I mentioned that this does not imply that you can't place orders at higher prices. That does not mean, uh, Parth, that Lucky asked this question, right? So that does not mean, Lucky, that you are bidding that price. Bid is meant for dealers only. The bid price and the ask price in core technical terms, it is meant for dealers only. Okay, if you want, you can say that is completely your choice of words. You can mention this at that this is your this these are the number of bids that you are placing, or these are the bid prices that you are placing. Completely okay. But technically, based on this and this, the bid and ask price, it is only the dealer who is bidding at the market price and who is asking for that market price. Okay. What else you asked?
Yes.
That's it.
Yeah.
Okay. So Vedant also has some feedback for you. Okay. I think Vedant is saying that the profits for the dealers would not depend on the market price of the stock directly. Absolutely, Vedant. Okay. Because they are more interested in the volume of the trades, right? They are more interested in the number of units that are being traded because they are earning that bid ask spread per unit. Correct. So, absolutely correct. It depends on the number of buyers and sellers who are approaching them. And then the next, okay, then Vedant is asking a question also. Number of buyers and sellers coming to the dealers would depend on the market price trends. Absolutely. It would depend on the market price trends, and the supply and demand based on the market perception for that particular stock. Okay. If I believe that, okay, we had Operation Sindoor some time back, and the prices of defense stocks might increase. Okay. Then some uh, some of the companies who are probably working with DRDO, they have say backed some new contracts with the DRDO, and their fundamentals are good. The demand for those stocks will become higher, and at each price you will see that there are more number of buyers as compared to sellers. It's possible, absolutely. Okay, anything else? Okay. Okay, so thank you. We'll end this session. Thank you so much.